Hey, what's up, guys? It is time to start thinking about taxes. This is the time of the year whenever hopefully you have a good idea, of where you stand on your tax liability. But if not, it's time to put the pedal to the metal and go ahead and start getting that in order, because if you need to make some investments in your business or get rid of some money, you need to know that well before December 31st so you're not rushed in making a decision. So in this video, I want to give you 3 tips this time of year, something that's going to help you, save money on your taxes, and then also, what I think about whenever it comes time to reinvest in our business. So tip number 1 is at this point in the year, you need to be taking your bank statements to an accountant, not just a bookkeeper that you're bringing receipts to and trying to get deductions by giving her your income and then the receipts from your business. You need to take your actual bank statements. I mean, you are getting naked in front of your accountant. Yeah, I mean, everything. You're taking every single bank statement from January, up until right now, taking that to them and letting them look through that, because they are going to find things in there, guys, that you had no idea that you could deduct, okay? All those meals and all those little things, a little trip to Home Depot that you forgot about or forgot to save receipts about, all that stuff, if you've been logging it on your business debit card, all of that stuff is right there. That's why I'm such an advocate, having an entirely separate checking account, for your business. So tip number 1, and if you don't do anything else, I'm telling you, if you take bank statements to your accountant, it will 100%, it will save you thousands, rather than just trying to organize your receipts and then take them to a bookkeeper or Jackson Hewitt or whatever and let them do that. I'm telling you, that tip right there will save you thousands, okay? So number 2 is you need to start thinking about the Section 179 deduction, and what that is it's qualifying purchases, which pretty much any purchase, if it's for your business, you can deduct the full amount of that item for the calendar year, even if it's financed. Okay, so why that is important is if you get near December 31st and your accountant is saying, hey, you owe this much in taxes, but if you make this purchase in your business, it's going to reduce your taxable income to a point that's more favorable to you. The accountant gives you that information, then it's your job to go out and then use that information and make a wise move with that. So what this 179 deduction does is it basically, any type of big purchases, it could be, a new mower, trailer, even trucks. If you're into landscaping, big pieces of equipment. But again, the cool thing about the Section 179 deduction is you do not have to get rid of all your cash. Like if it is going to completely strap your cash reserves to buy an asset outright, you can still get the full deduction even if you finance the asset, okay? That is huge, and a lot of people, let me warn you, will get in trouble in a vicious cycle of doing that over and over again. You need to have a conversation with your accountant on if it is better to fully depreciate that asset, under the 179 deduction, or if you should depreciate that asset over its useful life, okay? There's 2 ways you can take deductions on those. I will tell you, for me and my business, 99% of the time, I'm depreciating that asset over its useful life. That way, I get breaks every single year. But if you kind of got behind the 8 ball and you are needing, you're like, man, I don't have this money set up for taxes. You're not in a good situation. Taking the 179 deduction and fully depreciating a big purchase may save you a boatload in taxes, but again, you can really screw up if you do that too often and don't do it correctly. That is a conversation, again, for your accountant. Accountants are worth their weight in gold. Okay, and the third thing that I would tell you is that whenever you're looking at reinvesting into your business, whether you're looking at fully depreciating asset or financing it and depreciating it over its useful life, what I would say is when you make that investment, you need to be thinking about terms of, return on investment, ROI. There's a lot of guys who tend to go and overbuy on their trucks. They overbuy on their mowers. They overbuy on their equipment. And, if you go into that with eyes wide open and realize that, that $50,000 or $60,000 truck that you are financing and taking a deduction on, if you realize that was a stupid financial move, mathematically, then by all means, if you want a brand new truck, go ahead, but if you look at it mathematically, you need to be thinking in terms on return on investment, okay? And the way you think about that is, what is the least amount of money I can spend to give the biggest return? That literally is what return on investment is. That is what you're trying to do. You're trying to spend the least amount of money to get you the biggest return. And the way I have found to do that is this. You look at the thing in your business that you're doing best and you double down. If it's mowing and it's a particular piece of equipment, you double down on that piece of equipment. If your big money maker is aeration, then you double down on aeration. But look, if you are a mowing company and you do aerations on the side and that's generating you an extra $10,000 a year, it is not smart mathematically to add a $10,000 or $12,000 aerator to your business to do $10,000 or $12,000 in revenue for the year. It would be much more wise to bring on a $6,000 mower, a $2,000 trailer, and then finance a vehicle, and then go make another $100,000 by building out more routes. So my point is whenever you are looking at unloading money, don't just do it for the sake of, I'm going to offer an additional service to my client. It has to meet the test of return on investment, and it has to pass that. And if it does not pass, whatever your threshold is for your return on your money, don't do it. And you're going to see a lot of times, guys, that new vehicles, even expensive old vehicles, are not the way to go. Many times, adding an additional piece of equipment to your business, like a dingo or a caterpillar or whatever, if you're not working that asset wide open throughout the year, it does not make sense in terms of return on investment. So again, the best way to get the highest return on investment is to look at your business, see what it is that is the most profitable for you, and double down, all right? That's what we've done here. I just took a mowing route and literally copy and pasted it into the next year and build out more mowing routes. And we just doubled down with the same equipment, same setup, same everything that worked for us, and that has been a proven recipe for success. Guys, take your bank statements to your accountant, look at the Section 179 deduction, and then finally, whenever you're looking at investing into your business, think in terms of return on investment. That is going to set you up for success in 2020.